I get asked for my opinion on stocks all the time in my comment section, and I love taking a look at your best stock ideas. So in today's video, I want to take a look at some of the recent stocks that have been requested in my comment section. And make sure to leave a comment if you would like me to take a look at your stocks in a future video. Before we get into this video though, I just want to say thank you to everyone who has ordered a copy of my book, The Fundamentals of Investing, off of Amazon. It's continuing to get some pretty incredible reviews, and thank you to everyone who has taken the time to leave a review as well. Leaving a review on Amazon really helps get the book in front of more readers. So if you have purchased a copy and you have the time, then please consider leaving a review of my book on Amazon. I'd really appreciate it, and I am just thrilled that so many of you are enjoying it. And with that being said, let's now hop into the video. Alright, so the first stock that we are going to take a look at today is UNH, which is United Health Group. And if we take a look at its historical returns, this business has been an absolute beast. In fact, this was a $5.89 stock back in the year 2000, which means that it has almost 100x'd over the past 24 years. So the first thing that I want to do is actually take a look at its insights scores, because a 4.28 score on Stock Unlock is pretty dang high. So here we can see that its dividends do have a score of 4.25. Its dividend yield is slightly above its 5-year average. Its dividends have been growing by 14% over the past year, and its 5-year annual growth rate to its dividends has been about 16%. So this is very much so a dividend growth stock. Its financial health is also a 4.0. Its loss ratio is low for a healthcare and insurance business, and it does look like it is buying back some shares. So they are using some of the profits to buy back shares, it looks like. Growth is a 4.57. Its tangible book value is growing. Gross premiums earned are increasing very well. Revenue is growing, operating income is increasing, and net income is increasing. So this business is growing quite strong. Profitability is average with a 9% operating margin, but management score is 4.33. So it looks like the management here really knows what they're doing. The return on tangible equity is 23%, which is quite high. ROIC is 20%, which is also high, and it looks like the stock has outperformed the S&P 500 by about 17% over the past 5 years. So overall, it looks like this business has a very strong management team. It is growing strong, it has a good balance sheet, and its dividends are also growing. Now, the next thing that I like to do is take a look at its overall financials here, and I want to take a look at its long-term revenue growth. And here we can see that United's total revenue has been growing incredibly well over the past 20 years. It looks like basically every single quarter, actually, this business's revenue grows, and its revenue is sitting at an all-time high right now of about $360 billion in the trailing 12 months. So this is beautiful growth right here. This is actually awesome to see. Now, for businesses that are more in the insurance industry, I actually do focus on the net income over the free cash flow or operating cash flow metrics. And here we can see that United Health's net income is also at an all-time high of about $22 billion. So it does look like its profits are growing, and it is quite a profitable business. Now, then my question becomes, what is the price of this business relative to its historical averages? And here we can see that its price to earnings ratio is sitting at 22.3, which is about 10% above its historical average of about 21 if we want to round up. So it does not look like this business is on the cheaper end today, at least relative to how the market has historically valued it. And I typically like to buy my stocks below their historical averages, especially if I want more of a margin of safety or if it is a business in an industry that I don't really feel as confident on. Now, United Health, again, is a business that I personally don't really understand. Its historical returns have been incredible, but overall, it is in that industry that I don't understand, and I don't really know the moat of this business or why it's going to continue growing over the long term. So those are things that I would want to answer for myself before I become interested in it. But in terms of this business's fundamentals, they look absolutely incredible. That revenue growth was a thing of beauty, and its net income is also sitting at an all-time high, and it's got a really strong management team, it looks like, and the stock has historically massively outperformed the S&P 500. So this business does have a lot of makings of a very high quality business, but again, I would just want to understand its moat a little bit more. So now let's move on to the next stock that has been requested, and this one's been requested a few times, which is Zoom Video Communications, or ZM. Now, if you've been watching my channel for some time, you probably know that this is a business that I am not interested in at all. Even though the stock is down roughly 90% from its all-time highs, this is not one that I am personally interested in buying, and I personally do not want to own this stock at all. So if we take a look at Zoom's financials here, and we take a look at its revenue, it saw massive revenue growth during the pandemic and during COVID, but ever since the world has started opening up again, its revenue growth has really slowed down. It is still growing, which I am personally surprised by, and the revenue is hitting an all-time high right now, but I don't think that this is going to be a high growth business in the future. And I personally don't know if it's going to be producing this much revenue 5 years into the future. And the reason for that is simply because I use Google Meets for everything. I've never paid for Zoom, and whenever I need to use Zoom or I get sent a Zoom link, I just use Zoom for free. And again, I also prefer to use Google Meets, which I have never paid for. In my own business and in my own career, I have never had to pay for Zoom, and I would never see myself paying for this product when I can use other free products. Therefore, I do not believe that Zoom actually has a durable moat that is going to protect its business over the next 10, 15, 20 years. And that is something that I really try to focus on in my own investing now, because a moat provides an additional layer to your margin of safety, which is something that I do write about in my book. Now, if we take a look at Zoom's cash flow right here, we can also see that it is not at an all-time high. It peaked in the second quarter of 2021 at 1.8 billion, and then it did come down and it is now growing back up to 1.46 billion. And keep this in mind, okay? So the business produced $1.46 billion in cash. That is how profitable its operations are. However, if we take a look at the stock-based compensation rate here, in the trailing 12 months, Zoom has done $1.3 billion of stock-based compensation, which basically means that almost all of Zoom's operating cash flow is going towards paying the insiders with stock-based compensation. Now, I know that stock-based compensation is not an actual cash payment, but it is a stock payment that dilutes shareholders. So it's a reduction of shareholder value, and in my opinion, this is excessive, very excessive stock-based compensation. It's like 90% of the company's operating profits. Therefore, Zoom's operating cash flow is not creating any shareholder value because it's being offset by the dilution from stock-based compensation. And in my opinion, this is just way too much stock-based compensation going on. Like, think about it. This stock is down 90% from its all-time highs. And how do the insiders reward themselves? Well, they pay themselves over $1 billion worth of stock-based compensation, while the actual shareholders of the business, which they're currently diluting, have lost 90% of their investment over the past about 3 to 4 years now. That to me is a little bit ridiculous, and it's not, in my opinion, aligning the incentives of the people who run the business and operate the business with the people who are actually invested in it. Now, additionally, if we take a look at the insider transactions here, we can see that it is just a wall of selling. It's just selling, people exercising their options and then selling them immediately. And it's just a wall of selling. There's literally no insider buying going on. Now, what's also interesting is there is no insider buying going on while the stock is down 90%. And when a stock is down 90%, you would have to think that maybe the insiders would see some value there. Maybe they want to buy some shares of the business that they work at, because it could be a good opportunity if the stock is down so much. And in my own businesses, when the stock falls, I love to see the insiders buying more shares, increasing their positions, and increasing their convictions in the business. What I do not love to see is when the stock is down so much, insiders continuing to sell, because it's just like, it's the reverse of what should be going on, in my opinion. If the insiders believe the business is valuable, then I do not think that they should be selling the shares when the stock is down 90%. Therefore, that kind of tells me that the insiders do not really believe in the future of this business. They don't think that the stock is cheap. They don't really want to own it. And that, to me, again, is a red flag. So overall, I think that Zoom does not have a long-term durable competitive advantage or a moat. I personally do not see it. I am not confident that this business is going to be able to grow its revenues over the long term and maintain its current business. It is generating about $1.4 billion in operating profits annually, but that is being offset almost entirely by stock-based compensation and the insiders of this business getting rich while shareholders are losing all of their money. So there's a lot of red flags here for me in this business, and those are the reasons why this is not really a stock that I would ever personally consider owning. Now, the next stock that I have been asked to take a look at is CPNG, or Coupang. This business became public back in 2021, and it looks like the stock is down about 68% from its IPO. So maybe this is a high quality business that is just not seeing some love in the market. I do know that IPOs got hit pretty hard from 2021. So let's take a little bit of a look here. I took a very quick read on Coupang's business, and it seems to be some sort of e-commerce business, and it seems like it competes with Amazon. So right away, as an Amazon shareholder, I would already be wanting to compare this business to Amazon and just try to think, like, what makes me want to own Coupang over Amazon? And also, if this business is potentially competing with Amazon, then that's not really something that I would ever want to do as a business personally. So that's something that I would also consider. But anyways, let's head over to Coupang's revenue right here. And we can see that it is growing. It was about $12 billion in 2020, and it's grown to about $23 billion in the trailing 12 months now. So revenue has almost doubled since 2024, which is a good thing. And the revenue is also sitting at an all-time high right now. Now, if we head over to the business's cash flows, we can see that it was negative here in 2021, but now the cash flows have gone positive, and the business is doing about $2.6 billion in operating cash flow now, which is good to see. We can also see that the stock-based compensation right here was about 311 million, which is about, what would that be? About 15%-ish, 12 to 15%-ish of operating cash flow. That's a decent amount, but it's not nearly as high as Zoom. It's enough for me to overlook right here. So not a huge red flag for me. Its free cash flow is also growing to about 1.8 billion in the trailing 12 months now. This ultimately means that the business is trading for a price to free cash flow of about 15.6 today, which is a free cash flow yield of 6.4%. This actually is not an insane price ratio for me, because again, that's about a 6.4% free cash flow yield on the cost of the shares today. It also looks like this business's revenue is growing and its free cash flow is hitting an all-time high, and the free cash flow is actually growing quite rapidly as well. So those are all great things to see, actually. So if this business can continue to grow its revenues and its free cash flows in the future, and if I understood it more and I believed that it had a moat, then this would actually look like a pretty attractive price. Because again, this is not a high price ratio for a business that is actually continuing to grow quite well. So then it would come down to, again, understanding the business's moat, looking into the actual business more, and those kinds of things. But in terms of its fundamentals, they do look pretty solid. I'm not really noticing any major red flags here, and it does look like the business is continuing to grow. So let's move on to the next stock now, which is LAZR or Luminar Technologies. And I was asked if I believe that this is a 10x stock. So let's take a look. Well, it looks like this business was a SPAC back in 2021. And then when it became a SPAC and announced that it was going to become a company, it shot up 300% to $42 a share. Since then, the stock is now down 94%, which has almost completely wiped out shareholder value. So that is not very good to see, and this looks like it was one of the businesses that popped in the SPAC bubble. But now the question is the business looking valuable while it's down, what was that, 93, 94%, and is it an opportunity to buy today? Well, right away, I am seeing that on Stock Unlock, this business has an insight score of 2.15. Now, our insight scores on Stock Unlock are very good at pointing out fundamentally poor businesses. And whenever I see an insight score this low, it typically means that there is a lot of red flags to consider with the fundamentals of the business that you're taking a look at. This business has a financial health score of 3. It does have a cash runway of about 13 months, which does immediately tell me that this business is losing money and it's burning through its cash position. And with its existing cash position, it can survive for another about 1 year. So it's not going to go bankrupt within like the next 3 months or anything like that, but it is running out of cash. And then when that cash runs out, it's either going to have to take on debt or dilute its shareholders, which does destroy shareholder value, especially if it has to dilute when the stock is down 94%. Its current ratio is 4.54, has a low amount of intangibles, and the shares did increase by 10% last year. So it actually does look like the business is already starting to dilute its shareholders, and maybe that is why the company has some cash on the balance sheet right now. Now, if we take a look at growth, it is a score of 1.5. Revenue grew 40% in the past year, so that is good. Revenue is growing. However, gross profits are decreasing, operating income decreasing, net income decreasing, cash flows are decreasing, book values decreasing, everything else is decreasing. And now you guys know this if you watch my channel, and as I explained in my book, revenue growth is not the holy grail of investing. Revenue growth does not equal share price appreciation or the creation of shareholder value. What equals the creation of shareholder value? Well, the main thing is the business's profitability growing and its profits growing. So revenue growth without profitability growth is meaningless for shareholders. And this business is kind of a perfect example because again, revenue grew 40%, but the stock is down 94%. So revenue growth does not equal share price growth. You have got to have profits growing as well. And here we can see that the business's profitability score is 1.29. It's got a negative 100% gross margin. This means that this business cannot make and sell its product at a profit. It can't even produce the product at a profit. That is before factoring in operating expenses, taxes, paying interest on your debts, and everything else. Just producing the product, this business is losing money doing. That's a very, very bad thing to see. That's actually extremely bad. Operating margin is negative 1,000%. Net margin is negative 1,000%, and free cash flow margin is negative 500%. And it's also lost $567 million in the trailing 12 months. Major red flags here. Management score is also a 1, which is low as it gets. Stock-based compensation as a percent of revenue is 350%. That is insane. ROIC is negative, ROCE is negative, return on equity is negative, so the management here is doing an awful job. They suck. There's no other way to put this. So now let's take a look at what is happening with this business's revenue. So its revenue is actually growing quite well, okay? It produced about $58.8 million in revenue in the trailing 12 months, and revenue is growing. However, right here, we can see that the expenses of the business are much higher than the revenue. So this business is losing a ton of money. If we take a look at its cash flows, operating cash flow is declining massively. So the increase to this business's revenue is causing its profits to continue declining. That basically tells me that this business cannot scale either. Because think about it, if the profits are declining as the revenue grows, then it means that it's not able to scale its business profitably. And as revenue continues growing, so will the losses the business has. And this is probably because, again, it cannot produce its product at a profit. So the more product it produces, the more it loses money. Now, this is absolutely ridiculous right here. So remember, this business produced $58 million in revenue in the trailing 12 months, and the stock-based compensation in the trailing 12 months was $205 million, which is almost 4 times as much of the revenue. So the insiders here don't care if the business ever makes money. They don't care. They're getting paid hundreds of millions of dollars. The stock is down 96%. They don't care. They're going to continue diluting their shareholders. So this business has an incredible amount of red flags for me. And honestly, I don't even really know where to begin if I wanted to list them all out. But this is a perfect example of a business that I personally would not own in my portfolio. I think that it is very speculative. I also do not think that this business is cheap at all. Its market cap is almost $1 billion today, which means that it is 16 times revenue. It doesn't produce any cash flow. It's not creating any shareholder value. It's diluting its shareholders. It's losing money. It's doing a ridiculous amount of stock-based compensation. So there's a lot here that I simply just do not like. And this is a business that I would actually avoid like the plague. You cannot pay me to own this business. So to answer the question that I was asked, do I think that this business can 10x? I would say no. But in the market, who knows what's going to happen? If we see some sort of bubble in this business's industry, maybe it could 10x. But based on the fundamentals here, I really don't see anything to love. And this is definitely a business that I would just avoid personally. All right, so let's move on to the next business now. I'm sorry that I just ripped on that one, but you know, I get passionate about this stuff, I guess you could say. But the next stock that I was asked to take a look at is PERI, which is actually on one of my personal watch lists. I found this stock using our screener here, and it's also been asked about. So let's take a look. This is a $1 billion business. And it does look like it was worth about $2 a share back in 2018. So the stock is up 10x in about the past 6 years. Now, if we zoom out though, what I did notice is the stock price here seems to be very, very cyclical. So I would want to understand what happened to this business historically. Like, why was the stock so high? What happened during this period where it fell 90%? And why did it recover so much? Because I would want to know, am I simply buying it at a high here, and then it's going to go through some sort of cyclical event, and then I'm going to see some massive losses on my portfolio. Also, this business is trading for a price to free cash flow of 7 right now, which is a free cash flow yield of 14%. This is a very high free cash flow yield. What this means is if PERI wanted to pay out 100% of its free cash flow as a dividend to its shareholders, then they would get a 14% dividend yield today on the cost of the shares. But then my question is, does that maybe signal that the market is pricing in some declines to the business's future profits? Or does the market think that this business's profits are unsustainable and that is why they are pricing the stock so low today? Because if the profits decline, then the free cash flow yield will decline as well. So let's go take a look at this business's income statement and take a look at its revenue. So it looks like its revenue did explode here in about 2014, then it went down in 2015. And then it kind of struggled all the way out to 2019. But since 2020, this business's revenue has been going up a lot, and it is sitting at an all-time high right now. So if I was seriously considering this business, then I would have to be able to answer the question of how is this revenue going to continue growing? Because I do believe that the market is pricing this business as if it is not going to continue growing right now. So now let's go and take a look at its cash flows. And its cash flows historically have been a little bit cyclical, but they are currently sitting at an all-time high. Its operating cash flows of about $155 million. There's not a lot of stock-based compensation going on, and it is a very profitable business with free cash flow sitting at $155 million now. So that is all great to see. So now let's go and take a quick look at its balance sheet. So if we scroll down, it has about $473 million of cash, and its cash position is growing. That is actually very good to see. With the business being profitable, I do imagine that its cash is growing organically as well. And it looks like the company is just stacking up cash. Now, if we take a look at the company's total liabilities, it is sitting at $360 million. Now, what this means is the business has more cash than total liabilities. Or in other words, if the business wanted to, it could use its existing cash position and knock off all of its liabilities, become entirely debt-free, and still have about $120 million left over in pure cash. So that is actually very good to see. This business has a very strong balance sheet. Now, in addition to this business having a very strong balance sheet and having more cash than liabilities, it also is producing $150 million in free cash flow per year right now. So it's a very financially sound business. I actually don't think that this business's finances look like it is at any risk, at least in terms of its balance sheet. And actually, its balance sheet does look incredibly good. So my one question, everything really hangs on the question of, can this business continue producing this level of profits going forward? And can these profits continue growing? And then additionally, I would want to kind of figure out what is the management's plan with the cash on the balance sheet? Because cash is growing, the business is producing a lot of cash actually, especially relative to $1 billion market cap. So I would want to know what is the management planning on doing with this $470 million of cash? Are they going to start paying out a dividend? Are they going to start buying back shares? Are they going to try and acquire businesses? What are they going to do with all of that cash? That's something that I would really want to know as well. And then lastly, I would want to look into the business's history and figure out what happened from about 2014 to 2018, where the stock fell 90%. But as of the business today, in terms of its revenue, in terms of its cash flow, and in terms of its balance sheet, I'm actually not really seeing any red flags at all. Revenue's at an all-time high, cash flows are at an all-time high, the balance sheet is phenomenal. It's not trading for a ridiculously high price. In terms of its fundamentals today, not accounting for the future, I'm not seeing really any red flags, and this does actually look like a pretty high quality business, as long as it does have a moat and can continue to grow over the long term. But I feel like this video is starting to get a little bit long, so I'm going to cut it off here. And if you did enjoy this video, then please remember to leave a like on it. And if you want me to take a look at your stocks in the next video that I do like this, then make sure to leave a comment in the comment section below on the stocks that you want me to take a look at. Also, a lot of the fundamental analysis that I did in this video, I also cover in depth in my book, The Fundamentals of Investing. So if you want to learn more about fundamental investing and how to identify high quality stocks and analyze stocks on your own, then seriously go and check out my book, The Fundamentals of Investing, and read some of the reviews for yourself. The reviews the book has been getting have been absolutely incredible. And seriously, just go read the reviews for yourself, check out my book, and seriously consider picking up a copy if you do want to become a better investor and improve your ability to identify high quality stocks within the market. But that is going to wrap up the video for today, everyone. So thank you so much for watching. As always, I truly do appreciate it, and I really hope to see you all again in my next video.